You may not cast votes for them, nor do you see their names on ballots. Yet, they wield control over your residence, your employment, and even your personal information. In some instances, they exert influence over the politicians you elect. These entities do not engage in construction or manufacturing. Rather, they manipulate capital. This financial maneuvering grants them a level of authority that often surpasses that of elected leaders. In contemporary America, wealth does not merely converse. It dictates governance. Welcome to the realm of financial historians, where money intersects with power and history, revealing layers of complexity that defy simplicity. Many individuals are familiar with the term hedge fund, yet only a handful truly grasp its implications. The phrase itself conjures images that straddle the line between a legal loophole and an upscale landscaping service. However, lurking behind this term is one of the most formidable concepts in modern finance. However, how can one profit when a stock declines in value? The answer lies in borrowing. This process involves taking shares from a brokerage firm. Imagine a stock priced at $100. The borrowed shares are immediately sold at that same price. Later, if the value drops to $60, the shares can be repurchased at this lower rate, returned to the broker, and the trader pockets the difference of $40 as profit. Conversely, if the price increases, say to $120, the trader must still buy back the shares to return them, resulting in a financial loss. This method is legal and prevalent yet carries significant risks since potential losses can be limitless. Stocks could continue to rise indefinitely. Alexander employed this technique to hedge his bets and safeguard his investment portfolio against market volatility. He approached trading with caution and intellect, almost scholarly in his methods. However, decades later, this very concept would evolve into something entirely different. An industry built not on prudence but on leverage, secrecy, and power. By the 1980s, the United States had entered an era characterized by financial deregulation. The Reagan administration relaxed various regulations. With inflation curbed by the Federal Reserve, Wall Street was flooded with inexpensive debt. Suddenly, anyone capable of borrowing money could significantly increase their stakes in the market. Hedge funds were established precisely for this purpose. Unlike traditional banks, they did not require banking licenses. They were not publicly traded entities either. Hence, they were not obligated to disclose extensive information about their operations. They functioned within a gray area of finance, largely invisible to most regulators yet deeply embedded in the financial system. If an ordinary investor engages in chess-like strategies, hedge funds play poker using chips that belong to others at a table that the general public is unaware even exists. By the 1990s, hedge funds' influence surged dramatically. They operated across diverse markets including currencies, bonds, equities, commodities, and even entire nations. A notable incident occurred when a hedge fund named Quantum, spearheaded by George Soros, bet against the British pound in 1992, a move that led to a significant loss for the Bank of England itself. Soros emerged victorious with over $1 billion gained within just 1 week as he maneuvered from private investor status into national currency dealings. Such actions illustrate that he was not merely playing within market dynamics. He was building an empire. Then came a warning signal: long-term capital management, LTCM. Established by Nobel Prize-winning economists in the 1990s, LTCM represented what many perceived as the pinnacle of hedge fund sophistication. It employed mathematical models so complex that it appeared invulnerable at first glance. Its strategies seemed sound and well-researched. However, beneath this facade lay vulnerabilities that would soon reveal themselves in dramatic fashion. As LTCM's influence grew alongside its risk exposure, it became increasingly evident that even highly sophisticated financial models could fail under certain market conditions. The reliance on intricate mathematics combined with substantial leverage created a precarious situation that foreshadowed turmoil within global financial markets, one that would have repercussions far beyond its initial scope and reach. This evolution from cautious investment strategies toward aggressive speculative practices highlighted shifting attitudes within finance during this transformative period. As more players entered this high-stakes game armed with borrowed capital and bold ambitions, the landscape of investing underwent profound changes that would shape future generations of traders and investors alike while underscoring both opportunities for wealth creation and inherent risks associated with such pursuits. It was once believed that financial crises were statistically unlikely until reality proved otherwise. In 1998, a default on Russian debt triggered a catastrophic chain reaction across global markets. The bets placed by long-term capital management, a hedge fund, began to unravel, and the resulting losses posed a grave threat to the stability of financial systems worldwide. In response to this looming disaster, the Federal Reserve orchestrated a private bailout amounting to $3.6 billion to prevent a total systemic collapse. This moment marked a significant turning point for hedge funds as they gleaned an essential lesson. If you are large enough, the financial system will come to your rescue. Risk transformed from being an inherent danger into something that could be actively traded. As a result, hedge funds evolved beyond mere participants in market activities. They began to shape market dynamics themselves. They came to realize their ability not only to influence asset prices but also to sway regulatory policies in their favor. By the early 2000s, hedge funds had transitioned from niche vehicles catering exclusively to affluent investors into billion-dollar powerhouses wielding considerable influence over the economy. These firms hired former government officials and made substantial donations across both major political parties while lobbying for legislation that favored complex financial products. Their favored instruments included leverage and derivatives, akin to jet fuel and explosives in the financial world. A small fund could potentially control billions of dollars in assets through these mechanisms. To illustrate how this works, consider an example where you possess $1 million. You might choose to purchase $1 million worth of stocks outright or leverage that same amount as collateral to borrow an additional $9 million, allowing you to invest $10 million into stocks. At its core, a hedge fund operates as an exclusive investment club for affluent individuals. It pools together substantial capital from wealthy investors, pension funds, and corporations, all managed by a select team whose sole objective is to maximize returns through any legally permissible method. Unlike traditional investment funds that adhere to stringent operational guidelines, hedge funds operate with minimal regulatory oversight. In such scenarios, if stock prices rise by 10%, your gains would not merely be 10% but rather 100% on your initial investment. Conversely, if prices decrease by 10%, you risk losing everything invested. This high-stakes model typifies hedge funds. Substantial risk is paired with rapid execution and potentially enormous rewards, often fueled by borrowed capital from others. However, when these speculative wagers turn sour, the ripple effects can resonate throughout the entire economy. In 2008, when the United States housing bubble burst dramatically, a hedge fund manager named David Moretti foresaw impending doom on the horizon. Instead of just sounding alarms or warning others about the crisis, he took proactive measures by developing financial products designed specifically to profit from failing mortgages. His foresight led him to reap $20 billion in profits while countless families faced foreclosure and loss of their homes. This was the very same year that the financial system suffered catastrophic failures. Yet paradoxically, hedge funds emerged wealthier than ever before. The underlying message became starkly evident. One could short-sell the American dream and walk away with substantial gains intact. Following the turmoil of 2008, new regulations were imposed on banks that contributed significantly to the crisis in an attempt to mitigate future risks and ensure greater accountability within the financial landscape. As hedge funds continue navigating this complex environment, their strategies evolve while regulators strive to keep pace with innovative financial practices that often test existing frameworks designed for oversight and protection against similar calamities in the future. However, hedge funds, being private entities, largely evaded those regulations. They filled the gap by acting as lenders, landlords, and lobbyists simultaneously. These funds began acquiring homes at foreclosure auctions, often purchasing entire neighborhoods in one go. They transformed suburban residences into corporate rental portfolios that catered to an increasingly transient population. By the early 2020s, hedge funds and private equity firms had amassed hundreds of thousands of single-family homes solely within the United States. In certain cities, 1 out of every 5 rental properties was owned by institutional investors. For ordinary individuals, this shift meant a significant change in the rental landscape. No longer were they renting from a person but rather from a spreadsheet. A computer located in New York or London dictates how much rent is charged each month, how swiftly it increases, and whether tenants can remain in their homes. If any attempt is made to voice dissatisfaction or protest against rising rents, finding the owner of the corporation becomes an arduous task. The paperwork often traverses through shell companies registered in 3 different states and 2 tax havens. This is not merely corruption. It is a calculated architecture designed for profit. Following the financial crisis of 2008, banks faced stringent new regulations aimed at curtailing reckless lending practices. However, hedge funds remained unaffected by these rules and saw a golden opportunity to step into the void left behind. They began to engage in activities traditionally reserved for banks, directly lending to businesses, financing acquisitions, and even providing capital to struggling governments. This phenomenon became known as private credit, a shadow banking system devoid of traditional oversight. To illustrate this concept further, imagine your local bank denying your loan application. In this scenario, a hedge fund might readily accept your proposal but at double the interest rate. When others retreat from risk, hedge funds are quick to fill that space. They lend when no one else will and charge significantly higher rates while often seizing assets if borrowers default on their payments. By 2024, this private credit market had ballooned to over $2 trillion, roughly equivalent to the entire economic output of Italy. It represents banking without banks and extends far beyond mere loans. Hedge funds now exert considerable influence across all major markets that impact daily life: energy production, food supplies, housing availability, and currency fluctuations. During the pandemic of 2020, these investment vehicles capitalized on market volatility by betting against stocks while they plunged and subsequently made billions more by investing during the recovery phase just weeks later. Their strategies exemplify how interconnected our financial systems have become with everyday living, highlighting both opportunities for profit and risks for average citizens navigating an increasingly complex economic landscape. A mutual fund, often utilized by everyday individuals through their banking institutions, must operate within defined parameters. It cannot engage in excessively risky behaviors and is obligated to provide public disclosures regarding its investment activities. Navigating this landscape resembles driving along a well-marked highway with clear rules and regulations. Conversely, hedge funds veer off this established path almost immediately. In the wake of rising inflation in 2022, investors began to pivot towards essential commodities such as wheat, oil, and various metals, capitalizing on the growing scarcity. Households found themselves facing increased costs for groceries and fuel, highlighting a broader economic struggle. This shift is not merely a bet on future prospects. It represents a proactive stance in shaping market dynamics. When hedge funds initiate significant positions, their influence can ripple through the entire market, causing prices to fluctuate and prompting shifts in policy responses. Central banks also take notice of these movements, altering their strategies in reaction rather than adhering strictly to regulatory frameworks. This transformation signifies a fundamental change in capitalism where speed and scale redefine the rules of engagement. However, the phenomenon cannot be solely attributed to financial resources. It is equally about influence and connections. Hedge funds have emerged as powerful players with substantial political ties across the United States. They rank among the top contributors to both Democratic and Republican campaigns, showcasing their bipartisan reach. Executives from these funds often participate in exclusive retreats alongside lawmakers, forging relationships that can shape regulatory environments. Moreover, many hedge funds employ former Treasury officials as advisors, creating an ecosystem where those who develop rules end up working for entities that benefit from them. This practice, commonly referred to as the revolving door, raises ethical questions but operates within legal boundaries. The effectiveness of this system is evident. When regulators retire only to join hedge funds, they may begin lobbying the very agency they once oversaw. This cycle ensures that new legislation is crafted not to diminish power but rather to stabilize existing structures. The ingenuity of hedge funds lies not only in their ability to exploit regulatory loopholes but also in their capacity to profit from both stability and turmoil. During calm periods, they secure steady returns. When crises arise, they can strategically bet against prevailing conditions and emerge victorious. In this context, hedge funds have effectively monetized the concept of disaster itself. Take derivatives as an example. These instruments allow speculation on future price movements and have evolved into vast markets worth trillions of dollars based on contracts derived from one another. There are now derivatives linked to everything from climate changes and interest rates to natural disasters. Certain hedge funds have even ventured into issuing catastrophe bonds, securities tied to insurance payouts that offer high returns provided that no major disasters occur. Should a calamity strike, however, investor payouts are redirected toward covering damages incurred. Essentially, this means one can literally place bets on climatic conditions, transforming risk into yet another source of revenue. This approach extends far beyond the confines of Wall Street. It permeates various sectors where financial speculation plays an increasingly prominent role in addressing uncertainties. In this intricate web of finance and politics, hedge funds continue to redefine how risks are perceived and managed, while simultaneously enriching themselves through innovative investment strategies that capitalize on both potential chaos and calm alike. Hedge funds operate far beyond mere market transactions. They harness a wealth of data that fuels their strategies. These entities acquire satellite imagery to trace the movements of oil tankers, deploy thermal sensors to assess factory output, and analyze credit card transaction records to anticipate consumer behavior. By leveraging algorithms trained on vast datasets, they can predict how individuals will spend money, cast votes, or navigate their surroundings. This approach constitutes a form of financial surveillance that is entirely legal yet astonishingly expansive in its reach. In contrast to traditional finance, which resembles reading last quarter's report, hedge fund operations are akin to reading minds before any actions are taken. For this reason, some analysts refer to these funds as the new intelligence agencies within capitalism. They do not need to exert control over governments. Instead, their power lies in knowing government decisions mere moments before the wider public does. However, much of their influence remains concealed and structural. They borrow money to amplify their stakes in various investments and dabble in intricate contracts known as derivatives. Remarkably, they can still generate profits even when market conditions plummet. Although the term derivative may sound technical and intimidating at first glance, it essentially boils down to a financial wager on future outcomes. You are not purchasing the underlying asset itself, whether it's oil or stock. Rather, you are speculating on its future price trajectory. When hedge funds hold substantial stakes in residential properties, corporate debt, food supplies, or energy infrastructure within a nation, they do not require overt threats to wield power. Their very presence acts as leverage. They advocate for rent control while capital flows elsewhere. If derivatives face excessive regulation, liquidity can vanish overnight, an event that sends shockwaves throughout the financial ecosystem. Similarly, if speculation is penalized too harshly, pension funds investing billions into hedge funds could face severe repercussions. The entire system is intricately designed to keep capital circulating, regardless of who incurs losses when the flow ceases. Ironically, your own retirement savings may be entangled in this intricate web. Pension funds, endowments, and charitable organizations often invest in hedge funds seeking higher returns. Consequently, teachers, nurses, and municipal workers, whose financial futures hinge on these returns, unwittingly support the very forces driving up housing prices and commodity costs. This creates a vicious cycle inherent in modern finance, public money fueling private power. Yet here's the most unsettling aspect. Hedge funds do not view themselves as villains within this narrative. Many practitioners consider themselves pragmatic realists who provide essential services. They argue that they enhance liquidity and efficiency while fostering innovation within markets. In some respects, there is truth in these claims. They allocate capital rapidly, identify inefficiencies with precision, and expose underperforming companies. Thus, while hedge funds may contribute positively by making markets more intelligent through their innovative practices and rapid responses to shifts in data and trends, it is crucial to remain aware of the broader implications of their influence on society at large. The interplay between public interests and private gain continues to raise questions about equity and fairness in an increasingly complex financial landscape. The success of any power structure hinges on a fundamental truth. The concentration of authority inevitably accelerates until it reaches a breaking point. Empires do not fall merely due to financial depletion. They collapse when equilibrium is lost. History has shown us this repeatedly. During the Renaissance, merchant guilds in Venice controlled vital trade routes until their influence surpassed that of monarchs. In the East, the The East India Company established such a vast empire that it governed entire nations with a private army larger than that of Britain itself. In today's world, empires are no longer built on ships laden with spices or precious goods. Instead, modern empires are constructed upon leverage and data. Hedge funds have become the new trading houses, operating as private sovereign entities in a landscape where capital can outpace legislative action. These entities do not raise flags or openly declare their intentions. Rather, they focus on increasing profit margins quietly. They engage in funding both sides of conflicts without the need for territorial conquest, choosing instead to purchase wealth in the form of national debt. This represents the subtle yet profound control exercised over contemporary America. While politicians squabble over ideological differences, true power brokers engage in orchestrating these discussions behind closed doors. They finance political campaigns and shape trade policies, profiting from every headline that shifts public sentiment. In a system where every crisis can be monetized, even the concept of truth becomes just another variable to be manipulated. The real danger lies not in the mere existence of hedge funds but in their growing necessity within our economic framework. These financial institutions have become interwoven into the very fabric of our economy, functioning like veins of liquidity that sustain its vitality. Should they vanish overnight, financial markets would freeze, credit lines would dry up, and governments would spiral into chaos. This stark dependence is alarming and reveals how deeply entrenched these entities are within our economic systems. Thus, when one contemplates who truly holds sway over the United States, the answer does not reside within the hallowed halls of the White House or Congress. Instead, it is found in the quiet offices located in Greenwich, Connecticut, where spreadsheets and risk models determine national destinies well before breakfast is served. Historically, empires sought to conquer land and territory. Today's powers conquer liquidity itself. The tragedy does not solely lie in losing democratic processes to corruption but stems from a systemic exchange, piece by piece, favoring efficiency until control no longer requires explicit permission or oversight. While history may not repeat itself precisely, familiar patterns emerge over time. A new ruling class rises not through conventional politics but through dominion over debt, data manipulation, and human desires. It's akin to predicting whether rain will fall next week. However, these bets can be exchanged among participants for real monetary gain. This arena is where hedge funds excel, thriving amidst speculation, speed, and secrecy. Every empire constructed upon leverage eventually confronts an inevitable lesson. One cannot indefinitely short-sell an entire system without facing repercussions. The intricate dance between power and finance continues to evolve, creating new dynamics that challenge our understanding of governance and control in an increasingly complex world. If this has provided you with a fresh outlook, the narrative holds the key to understanding. I will guide you on where to uncover these insights and answers. The inaugural hedge fund was far less perilous than its modern counterparts. Established in 1949 by Alfred Winslow Jones, a reserved sociologist with an innovative vision, the original intent was straightforward: acquire stocks expected to rise while simultaneously shorting those anticipated to decline. This foundational strategy laid the groundwork for what would evolve into a powerful financial instrument that continues to shape markets today. As hedge funds grew in prominence throughout the decades following their inception, they began adopting increasingly complex strategies aimed at outmaneuvering market fluctuations and maximizing returns for their investors. What started as a modest experiment has transformed into a multi-trillion-dollar industry that plays a pivotal role in global finance. In essence, understanding hedge funds requires delving into the intricate ways they navigate both opportunity and risk within the financial landscape. Their capacity to thrive under diverse market conditions showcases not just their adaptability, but also highlights the profound impact they have on economic dynamics worldwide. As we continue exploring this fascinating world of finance and its intertwining relationships with power structures throughout history, it becomes evident that hedge funds represent more than mere investment vehicles. They embody a significant force shaping our contemporary economic reality.